Hi, I'm Brian Douglas, the FICO Insider. Today, let's talk about factors that affect your FICO score, which is the key to successful credit repair. You know, a high FICO score is the prize you're looking for when you're trying to repair your credit. In order to win that prize, you need to know how the FICO boosting game is played. You may be surprised to learn that factors such as your age, sex, education level, marital status, whether you own your home or rent, your length of employment, and even if you may pay more than your minimum monthly payment, those are not included in your FICO score. The exact formula that makes up your FICO score is top secret, kind of like the formula for Coke and the Colonel's secret recipe. But basically, here's how it works in order of importance. 35% of your score is based on how you pay your bills. Now, paying on time is great, and paying late hurts you. No big surprise there. If you have accounts that are charged off, or if you file bankruptcy, you're really going to take a hit here. Recent activity is more important than older activity. In fact, if you have had old bad debt, the best thing to do is leave it alone. 30% of your score is based on how much credit you have available and how much you're using of that amount available. This includes all credit sources, home equity lines of credit, car loans, mortgages, credit cards, and so on. It's bad to have almost no credit. It's good to have a reasonable amount, and it's not great to have too much. Why too much? Because statistically, if you have the credit, you'll use it, and that translates into risk. Lenders want people who have enough credit available to show that they're responsible, but no more. The key to a high credit score is to not only use the credit you absolutely need, but keep your balances reasonable and make those payments on time. Speaking of payments on time, 15% of your score is the length of your credit history. Long-standing relationships with creditors will help you very much here. For example, if you had a mortgage loan for 10 years without refinancing it, you'll get many more points than if you refinanced every couple years. Likewise, if you had the same credit cards for many years, that looks good. FICO and your creditors likes to see long-term relationship with customers. So if you have a credit card that you've had for a long time, but you hate the credit card company, don't close it out. Keep it, because that will help you. 10% of your score is the variety of your credit accounts. You'll do much better here if you've had many different types of credit, say a car loan, a mortgage, and a few credit cards. If you have only installment loans or just revolving credit, that's credit cards, of course, you won't score as high. Mix it up a bit. Just as you should have some variety in your social life, you should have some variety in your credit mix. 10% of your score is based on the number of recent applications for new credit. So if you're shopping around for a new loan or floating balances between new credit card accounts, you may look riskier to the credit card companies. There are some strategies here to minimize that. Now, that's 100%, but there are other factors to consider too, and FICO does include them to some degree, so you need to be careful about some of those factors as well. So there you are. That's just the knowledge part. Now comes a strategy of what to do with this information. To get the rest of the details about what to do next and receive my free special report, The Great Credit Score Scam Revealed, visit creditreboundinstitute.com.